Welcome, everybody. This is our quarterly House Views podcast with Park Madison Partners. And our guest today is Carrie Coulson, who's a principal with Park Madison. And welcome, Carrie.
Thank you, and thank you, Jeff, for having me. I've long been a fan of yours and of the IREI platform, so thrilled to be part of the webcast series.
That is so cool. I've actually heard there was somebody out there that knew something about us. That's terrific. I find it that's one. Anyway, we're going to talk a little bit about your view because you, as a placement agent, are constantly out talking to investors, you're talking to operating partners, you're talking to investment managers. And so you get a different perspective than perhaps we do as editors looking at things a little differently. So, how would you describe investor sentiment today versus, say, a year ago?
So, at the beginning of each year, we actually put out a market outlook piece, and it's a great opportunity to connect with the investor and consultant community to get a read on, share our perspectives, one, but also get a read on their view of the market and the year ahead. In 2025, it really did start with an opportunistic outlook. The early momentum was really strong, but it just went pencils down after Liberation Day, and everybody just sat on the sidelines for the rest of the year, given the macro uncertainty. So perhaps we all put too much stock into the tagline of stay alive till 25, because in reality, it just ended up being a wait and see mode for the rest of the year. But as 2026 kicked off, there really was renewed optimism and just a much more constructive tone. And we've seen investors shifting from the sidelines to having more active conversations about deploying capital. So that's been a great signal and sign to see. We are continuing to see that a lack of distributions is an issue, but we do have reason to be optimistic. A few stats include the fact that a survey of managers projects investment volumes to be up 16% in 2026. So that should certainly translate to distributions. And we also have investors under allocated to real estate by about 90 bips. So we're hopeful that that translates into increased allocations.
Okay, so last year we had the tariff announcements, the Liberation Day, as you mentioned. This year we started off great, and then we had the Iran war. How do you describe or explain the difference in sentiment? Why aren't we, kind of deer in the headlights again? What's
Yeah.
driving the shift in sentiment, do you think?
So I think, well, one, I think the stock market isn't exactly listening to the headlines. So, the denominator effect isn't as big of an impact as it was in past years. I also think at some point, investors have to sit back and say, I'm giving managers a 10-year remit on my capital. So I can't predict over the next 10 years what events are going to happen. There are going to be swings. We know that. And one thing that investors learned post GFC was those were the best years to put capital to work, but a lot of people sat on the sidelines. And so if you skip too many vintages, you're going to miss out on great investment opportunity. And I think people are finally saying it's just time to get back into the market.
Yeah, well, just as a side note, at our editorial advisory board meeting last week at Boca, um, one of the issues that was top of mind for all the investors was global geopolitics, right? But when we got into discussion, one of the very large public fund investors said, hey, look, it's all noise. I mean, if you take a look back at history, there's never been a time when there's something going on. And we can't run our fund based on what the news headlines are. We got to, continue to allocate capital and continue to try to, maintain our mandates. So I think that adds a little to it as well. So which property types and strategies are resonating with investors? What's attracting capital today?
So the darlings haven't really changed over the past handful of years. They really continue to be the stars of the show, and that's multifamily and industrial. You hear that time and again from investors. Both are really driven by durable income and clear demand fundamentals. So typically, though, when you're talking to investors, they've really picked their horse in the traditional multifamily and the traditional logistics or industrial segments. And so the things that are resonating are what I would call multi or industrial adjacent. So in the housing segment, we've really seen an uptick in interest in manufactured housing. it really hits a number of fundamentals that are interesting to people. So obviously on top of the affordability play, you have stable occupancy, durable cash flow, limited CapEx requirements, and fragmented ownership. So it's a bit of the perfect storm in an institutional marketplace to capitalize on opportunity. Also in housing, I think we're seeing an uptick in interest in senior, which is really driven by demographic tailwinds.
Hmm.
Shifting to industrial, both final mile and iOS really stand out in terms of investor interest. On the final mile side,
iOS, for people not familiar with it, is,
oh, sorry about that, industrial outdoor storage.
right?
So on the final mile side, we're seeing really a flight to quality assets and an increased focus on assets that are AI ready. So what does that mean? Modern specs, enhanced power, and automation ready infrastructure, both for e-commerce and for manufacturing. So simply said, we're seeing tech requirements reshaping space needs and leasing trends.
Okay.
On
Now,
the, oh, I was, go ahead.
no, go ahead.
I was going to say on the industrial outdoor storage side or IOS, which I mentioned, those have some of the similar characteristics to manufactured housing. So supply constrained, limited CapEx, durable income. So that's been an interesting segment as well.
Okay. Now, since COVID, everybody's been waiting for the distressed market shoe to drop. Um, how should we be thinking about distress in today's market?
So I wouldn't say that there's broad-based distress. I think it's more targeted than many would expect. We are seeing some certain markets have more distress than others. So for instance, New York City, we're seeing as a good example, it's really in a restructuring cycle despite really strong macroeconomic backdrop. So on the macroeconomic side, you have a diversified economy. So beyond the traditional segments of, financial services, for instance, driving leasing, you have AI and tech firms driving a fresh surge in leasing. Employment and labor participation are all-time highs. Multifamily rent growth is up over 4% year over year. And interestingly, office visits are down just under 10% from pre-pandemic levels. So it's creating an opportunity for investors who can step in and recapitalize some of these broken structures.
So, after COVID, a lot of investors in every domestic region around the globe kind of adopted a stay-at-home mentality. Um, are investors thinking more globally today?
We have seen an uptick in investors interested in diversifying outside of the United States. I would say that, Europe is low growth and tends to have a reasonably high correlation to US real estate. So the interesting piece is that we have seen an uptick in interest in investing in the APAC region. There's compelling demographics and growth trends, but also low correlation to US real estate. From a statistical standpoint, APAC represents 60% of the world's population and contributes 40% to the global GDP. But the size of the institutional real estate market is smaller than that of the US. And capital raised for the region was just 20% last year of what was raised in North America. The segments that are driving interest in APAC are driven by demographics as well as digital infrastructure. One interesting statistic on the digital infrastructure side is that India alone consumes and generates 20% of the world's data, but holds only 2% of data center capacity. So there's certainly a structural mismatch between consumption and physical infrastructure.
Is there developments being done in India, or is there regulatory or government restrictions on allowing that to happen?
No, there are developments being done. I think the government is empowering developers to build out the infrastructure in the market.
Now, you mentioned that Asia is, such a disproportionate share of the global economy, but not so much when it comes to institutional real estate. Well, how do you explain that?
I think it's a developing market, and there was a rush into some of the developing markets when the BRICS were hot. And I think that some people got burned in investing in those markets way back when. But the tides have turned and it's become a more institutional market. And there are also, if you're looking at the APAC region, there are, several handfuls of institutional managers. And so it's easier to wrap your arms around the number, but with only a handful of institutional managers, compare that to the multifamily set in the United States. A couple years ago, there were 70 plus funds in the market. So there's just not as much optionality, but it's continuing to institutionalize.
And if you were going to look at the capital sources, also, the number of institutional investors is somewhat smaller. Um, but if you added in the family office sector, which is so big in Asia, would it compare to any other region in terms of capital availability?
So that's a good question. I mean, family offices, it's hard to really opine as to how much they're investing because a lot of it's direct in which we don't see, right? We're focused on raising capital for the fund structure and for recapitalizations. And the family offices, a lot of times, one, they're opaque, but two, they like to invest and hold assets, A, directly and B, long term.
Okay. So how would you characterize the fundraising environment? How has it changed over the past 5 years? And where do you see the capital really coming from today? What sectors are most active in allocating new capital to investment managers or to operators?
Sure. So Park Madison's been around for 20 years and we've raised $30 billion over that time frame. And so I actually went back and did an analysis on where the capital has been coming from and kind of split it into rough justice 6 or 7 year periods. And what's happened, right? So the public pensions, the first third of our lifespan, essentially was about 50% of that of the capital we raised. That dropped to in the next third to about 40%, and it's subsequently dropped to about 35%.
Hmm.
So public pensions are still putting out capital, but I think that trend in terms of our client base and capital we've raised might be due to the fact that public pensions have fairly mature portfolios and so might be re-upping with their existing managers, along with the fact that they're consolidating managers and the number of managers that they have in their portfolio. We've seen the insurance endowment and foundation segment, we've seen that be flat. Private pensions have dropped. So this all begs the question, where's the growth coming from?
Yeah.
And that's been through asset managers and then the family office, high net worth and RIA space. Not surprising, given there's been tremendous wealth creation over the last decade or two. And on the IRA space in particular, it's playing a larger role as an intermediary for private wealth. We're seeing real growth in that space, but also a lot of consolidation. What's
And
also changed is, oh, go ahead.
I was going to ask, how is it different from your perspective, raising capital from that sector versus from institutions? What's involved in it? Is it more complex, less complex? What do you think?
So a lot of the RIAs have different offices in different locations, and they're all making decisions differently. So you've got to get in front of each of the different offices. So it is a heavier lift for sure. I mean, I also looked back, we used to cover in any fundraise to get a fundraise to target our hard cap 400 to 500 investors. We're now covering 1,200 investors in any fundraise. And so I think that's reflective of the growth in the RIA segment, as well as the family office and high net worth capital has been much more active.
It can take anywhere from 18 to 36 months or more to capture an institutional mandate. Um, how long does it take to get approved, if you can get approved, on an RIA or a private wealth broker dealer platform?
So I would say the private wealth broker dealer, they're typically investing in the large, 3 to 5 billion dollar plus funds, which is not where we play. But on the RIA space, I mean, we got approved in a platform, took maybe 3 to 5 months, but then you've got to run around to each of the offices and continually educate. And so it just takes a really long time to get that capital to come in.
Yeah, it's a two-step, isn't
It's 20 step.
it? All right. So, What are investors prioritizing when allocating capital today? What are they hungry for?
So I think, as you mentioned, first and foremost, fundraising is just taking longer. I mean, the days of the 12 months fundraise are long gone, as are the days of the one and done close. Um, that said, there was recent data that while the last 2 years, the average was 24 months from first to final. In Q1 of 2026, that dropped to 19 months. So hopefully that's some positive. Also positive, it was reported that 68% of funds that closed in Q1 either reached or exceeded their target. So much different from prior years. So 65% and 48% in 2024 and 25 respectively did not meet their targets. So nearly 70% meeting or exceeding is a big change.
Wow.
We're also seeing a big shift in how investors are evaluating performance. So the new catchphrase, there's always a catchphrase in this industry, right? Is that DPI is the new IRR. So investors are placing much more emphasis on realized returns and actual cash distributions.
Okay, again, for those who are not familiar with the term, although they must be hiding under a rock if they aren't, but what is DPI?
So DPI is distribution to paid-in capital. And as I said, investors are much more interested on DPI today. They're really wanting cash flow and income generation, exit visibility, and at the end of the day, people are getting back to the basics of why they invested in real estate, and that includes cash flow along the way and not just a back-end return.
Yeah, interesting. Okay, now you mentioned the sentiment is getting better. Is fundraising getting easier or is it still hard?
So nothing is easy. I mean, capital is available, but it's really concentrated around strategies where investors have high conviction. It's the story of the haves and have-nots. I mean, one thing we talked about retail and logistics. Another sector of interest that we didn't touch upon is data centers, right? And so data centers continue to be quite interesting to people. I think there are concerns about a potential AI bubble, but it's data centers are not just the hyperscale centers that you read in the headlines. There's also co-location and carrier hotel facilities that are lower latency, closer to eyeballs, lower power requirement, and diversified tenant base. So that's also interesting to folks.
Do you think we're headed for a bubble in AI or not? You know, it's
I
hard
think,
when you talk to the data center people, of course they say no, but
yeah, I mean, look, I think the technology in the hyperscales is going to change pretty rapidly. If you think, look, 5 years ago, had you heard of a hyperscale data center? Um, I think at the end of the day, and everybody's going to continue to use their devices and everybody's using AI more and more. And so I don't think it's going away. You are seeing obviously the top seven continue to spend, I think the last was 700 billion over the next 5-10 years on AI. So I don't think it's going anywhere.
so today there's a lot of different capitalization structures in the marketplace. What role are these alternative capitalization structures playing in the market today? And how important are they?
Yeah, so they're playing a really significant role. I mean, it's really become a core part of our business at Park Madison. We actually have a dedicated capital advisory team that focuses on recapitalization, and it's become a really substantial volume and substantial piece of our business. And what's really driving this is the fundamental mismatch between the assets that are performing well operationally, but they're just sitting in capital structures that were built in a very different environment. And traditional exit paths remain constrained, right? And so LPs want liquidity and GPs are under pressure to generate DPI and manage fund duration. So we're seeing these GP-led transactions allow the market to clear in a more bespoke, non-traditional way. And in fact, GP-led transactions last year, there was $20 billion that transacted, which was up 40% year over year. So we're really seeing sponsors using this to actively manage capital and liquidity and duration.
So
And
why do you think recaps are such a focus in this current environment?
well, I think one of the reasons is that the market isn't clearing in the traditional way because people don't want to dispose of assets in a somewhat broken market. Also, there's just been a tremendous amount of capital formation in the space. So over the last 2 years, $15 billion was raised for secondaries vehicles in the real estate segment.
Now
And we
that was
actually think this underestimates or understates the amount of capital that's actually chasing these recapitalization, because that doesn't include the large asset managers, sovereign wealth funds, SMAs, and others that are transacting outside of the dedicated secondaries vehicles.
forgive me if I raise an issue, but you earlier said DPI is a driving factor. And recaps really extend the length of these programs. How do you reconcile those two things? The appetite for recaps versus the appetite for DPI.
Because typically in a recapitalization, you're taking out the original investor and putting in a new investor. So that gives the original investor liquidity. It gives the manager the ability to hold on to the assets and work them through their business plans, reset the basis. And again, the initial LP is recapped out.
But the initial LP is leaving because they haven't been pleased with the DPI. And the new investors coming in, are they looking for something other than DPI? Or are they expecting, because their capital is fresh, that somehow the timing or something's going to change and they're going to start seeing distributions?
I think that there's typically the assets have been held for a number of years with under the original structure. The original investor is looking at their book saying, we're not getting liquidity from many of our managers. And so what's a way to manufacture some liquidity? And so they've been okay with exiting through recapitalizations. And the new capital coming in, they get a reset basis, right? And then they understand that the hold period might be a little bit longer than, the original underwriting, but they're coming in maybe halfway through the business plan.
And what kind of discounts are they getting when they're coming in to recap?
We are seeing a bit of a discount to the last marks, so not super meaningful, but they are coming in oftentimes below replacement cost, some downside protection in terms of structuring, decision making, multiple minimums, things like that.
So it's really a basis reset play for the new investors. What are investors in general looking for today in terms of return expectations and deal characteristics? Have that changed much, or is it pretty much the same?
I think the deal characteristics around the edges, I mean, they remain the same. Durable income, which we've talked about, that is one of the things that matters the most. Defensive basis, investors want to buy at or below replacement cost with real downside protection embedded in the structure. They're also focused on conservative underwriting, so really scrutinizing all of the underwriting assumptions, um, and controls matter, structure, right? So, and then in terms of return targets, you're still really seeing mid-teens for value add, and high teens to low 20s for opportunistic recapitalizations. And there has been a greater focus on, as I've said, on cash flow, right? And understanding that it's not just going to be back-ended returns.
Okay, so can you net this whole discussion out for us? How would you summarize the market today? How would you characterize it today?
So stepping back, I'd say that we're in a market that's still working through a reset, but one that's creating opportunity for those who are well capitalized and disciplined, right? So the themes we've discussed, targeted sector conviction, evolving capital sources, and the rise in alternative structures all are pointing to really a more solutions-oriented market. And I think the market is starting to clear, and as mentioned, just not in a traditional way, but there's just been capital sources formed in order to enable the clearing of the market.
Great. Carrie, thank you for helping us today and taking some busy time. I know you're really busy and I really appreciate this. And I'm amazed that you could be quite as sharp as you are, having just gotten off a plane from Japan. So,
Well, thank you. Great to be with you today, and I certainly appreciate your time.
yep, best to Nancy and your partners.
Absolutely.
Take care.